Welcome back, everyone. Today's video will be the first in a series, a newer series that I'm calling my watch list, where I'm going to be talking about some stocks that are at the top of my watch list that I'm looking at buying but don't own yet. And so, without any more ramble, today's video is on Altius Minerals. Now, unfortunately, I lied. There is a bit more ramble. Most of what I discuss on this channel, much of the uranium, I guess you could qualify it as speculation by most people's definition of investing. Now, in this case, in Altius Minerals, it is more so investing because this is the type of thing that this company is profitable, pays a dividend, buys back shares instead of issuing them. I know that's crazy in the natural resource space. Doesn't really make sense to me either, but that's what Altius does. So this is a sleep well at night, could own a lot of, and not really have to worry about them burning money type investment. And that is very different from much of the other speculation. So when I'm investing in the natural resource space and not speculation or not trying to play a upward moving commodity price or whatever, when I'm investing, I really like royalty companies. Now, why do I really like royalty companies? Well, they make money. By that I mean they have margins, they have predictable cash flow, and they have strength in markets that are normally cyclical, volatile, and at some points in markets, there's a lot of miners that are not making money or losing money or just breaking even for big stretches of time. Whereas royalty companies, predictable cash flow, predictable costs, yes, some of the royalties can have problems, but they're diversified, and this stream of profitability, cash flow gives them strength to be able to do things, have opportunities while the rest of the industry struggles. And I would highly recommend Taleb's book, Anti-Fragile, works on a concept like this, but royalty companies, I see them as anti-fragile. Now, royalty companies are also can be great inflation hedges. Why is this? Well, many people will say if you see inflation coming, go into commodities. And that's a fair point. I agree. That's how it has worked much of history. But here's the thing. As commodity prices go up because of inflation or vice versa, well, so do the input costs. So yes, there will be margin expansion. Yes, you'll probably make more money in the miners. But there's also the constant concern with the turn of a cycle in that you're not going to things aren't going to be getting better forever. Whereas if there's inflation, whether it's a steady burst of inflation for a royalty company or if it's just slow grind of inflation, well, you have your costs up front fixed. You buy the royalty and you get the cash flow. And so it's a great hedge because as the value of money goes up, or sorry, goes down, because yeah, who am I kidding? We live in this world. Um, the the commodities price goes up, and so does the cash flow for this company, thereby directly increasing the profitability as prices inflate. Now, looking within the royalty space, you look at the management of Altius, and you see a bunch of great decisions that they made. No one's perfect, obviously, but if you look at when they've made many of their purchases, they've navigated cycles fairly well. and that has helped them. And another big thing is they know what their shares are worth. They have been able to use the share capital effectively and buy back shares when the price is too low, issue shares to buy things when the price is too high. This is a critical ability especially in the resources space. The management in Altius has demonstrated that ability and has done a fantastic job so far, and they own a significant piece of the company. So then, looking at the setup that Altius finds itself in, they have a fairly stable balance sheet. They do have a bit of debt, but they have plenty of cash flow and they're paying down the debt, and they issued it at a great time at around the bottom. Well, that was a few years ago. Maybe we go lower now, but maybe not. They issued that and they spent money when the market was offering it the biggest opportunity. But now the balance sheet is fairly stable and they have organic growth. They have a pipeline of, to borrow the line from one of their, not peers, but another royalty company, if they were to fire everyone and just shut down operations, the cash flow would still grow in a few years. And that's a great way to have things set up. And so that is how they have built their business. Now, because this company is a royalty company, it allows them to have a number of smaller assets that kind of make up their portfolio, kind of like you might have. They can have different views, different commodities, and have a balanced approach. And that is what Altius does. They have a number of different divisions. They're investing in different companies, different sectors where they see the opportunity. And so it is possible that they get impacted by a number of little things that can go wrong, but it would take a lot of things to go wrong to hurt them badly. So there's a bit of a trade-off, but in the end, I think that this is a strength of theirs and it makes each possible problem less potential to be crippling. Now, the biggest risk for this company, I guess, would be some sort of crippling wave of deflation. And if they couldn't refinance the debt, and I'm talking like really, really bad wave of deflation, which would cause a whole lot of trouble for a whole lot of companies and not just them. And I'm talking really bad now. So I don't think that that's necessarily likely. I think that a break to the inflationary side is more likely, I guess. I mean, either can happen, but I think that the money printing powers that be will fight deflation with every power that they have. Could be wrong. Okay, now I hear you pushing back. If this is such a great company and such a great setup and is growing and whatever, why is it just on my watch list and not on my portfolio? Well, here's the thing. I do definitely believe it's a very, very solid, very high quality company, deserving of a fair price. But I'm very passive, I would say, at buying things that I don't consider insanely cheap or brokenly cheap or possible to, I don't know, have a speculative bend to me, I guess you could call it. And so I rarely own super high quality names in a space. And so that for that reason, I really, on this one in particular, would I'm looking for a bit more of a discount. Now, I don't know if it'll happen, but that's why I don't own it, because I'm just looking for, I'm just too cheap to just buy it. I'm just hoping that maybe it doesn't go down a bit more, but if it does, that I'm ready. The bottom line is, I think this is a quality company that's doing many things right and going in the right direction. They're growing revenue, decreasing the share count. Uh, they're growing. They have a project pipeline and many good opportunities going forward. So I like this as a limited risk, or if you were looking for exposure to commodities but don't really like taking risk, this is, I think, a good way of doing it. Now, some people are very risk averse, and the commodity sector is, let's just say, more uncomfortable for those people. And if there was someone who is risk averse looking for a commodity investment, I would think that this is probably the way to go. The reason I don't own it is because it's priced reasonably, and I really don't generally go for that risk averse type of investment. But if I was looking to add to something to my safer section of my portfolio, that is what this would be for, and that is why it is on my watch list. Thanks for watching, everyone. That's all for today. Remember, this is never investment advice. Do your own research on everything before even considering it.